Money FM 89.3. Best of breakfast. Eco Money on Money FM 89.3.
That's right. Welcome to Eco Money. Infrastructure dates back to the first human settlements, making it undoubtedly one of the world's most ancient asset classes. And so it comes as no surprise that the United Nations Sustainable Development Goal on Industry, Innovation and Infrastructure is often seen as the most investable goal, with the OECD estimating that about $95 trillion worth of investments in sustainable infrastructure are needed globally to meet that target by 2030. To that end, institutional frameworks to finance and develop infrastructure projects remain a key consideration. For more insights, we welcome to the show Laurie Kerr, the CEO of FinDev Canada. Thanks for joining us, Laurie.
Thank you so much for having me on the show today.
Yeah, you're very welcome. Now, just to contextualize for listeners who may not know the lay of the land when it comes to FinDev Canada, what's the institution all about? What do you guys do?
Absolutely. So for those listeners who may not know us, FinDev Canada is Canada's bilateral development finance institution. We were established in 2018, and we support development through the private sector by providing financing and investment, blended finance solutions, as well as technical assistance and advisory to support sustainable and inclusive growth exclusively in emerging markets and developing economies. We work across three sectors: the financial industry, agribusiness, forestry, and the related value chains, and sustainable infrastructure. And in addition to supporting financially and economically viable investments as a development finance institution, we're also focused on impact and have three impact goals through which we look when we make our financing and investment decisions: climate and nature action, gender equality, and local market development.
All right, great stuff. Let's talk about the financing of sustainable infrastructure projects then. What criteria does FinDev Canada use to assess whether a project is truly sustainable, both in environmental and economic terms?
So to answer your question, FinDev Canada seeks to deliver both financial returns, as I mentioned, and measurable development impact. We have our development impact goals, which I just mentioned a moment ago, and our clients do report on their development contributions. Internally, we have dedicated teams and processes to assess both financial and credit aspects of all potential financings and investments, as well as teams dedicated to non-credit areas such as environmental and social, climate, and integrity risks. On the environmental and social side, like most of our peers, we leverage the International Finance Corporation's environmental and social performance standards. And of course, there's the impact. We also have a dedicated team that assesses impact across our three impact goals, as well as works with clients to understand the impact that can be enhanced through our participation in a transaction and opportunities to strengthen that. This opens the door to technical assistance, grant capital that we have that can be used alongside a loan or an investment to build capacity in areas related to impact, for example, developing a gender action plan or a sustainability framework. And wherever we operate, which now includes the Indo-Pacific, it's actually why we're here in Singapore this week as part of the Government of Canada's broader Indo-Pacific strategy. FinDev Canada's mandate was expanded to include this region, something that we are extremely excited about. And yesterday at the Canada and Asian Conference, which convened over 700 leaders right here in Singapore, we were thrilled to announce the opening of our very first office outside of Canada here in the dynamic financial hub of Singapore.
Fantastic. I'll get to your plans in the Indo-Pacific very soon. But first of all, let's get a little bit more granular and zoom into one of the projects by the name of Kerr, which was completed last year. That's about just under a $19 million deal, part of a $56 million package to support solar energy power generation in the Dominican Republic. So what's happening out there? Can you let us in on the progress so far?
Sure thing. So when our client first came to us, the Dominican Republic was working to reduce its dependence on fossil fuels by increasing clean energy production towards its commitment to achieving a 27% reduction in greenhouse gas emissions by 2030. To support Energía Turística, or Enertour, as you mentioned, we provided a loan to finance the development of a greenfield solar PV plant with battery storage that will produce up to 78 megawatts of renewable power and avoid 90,000 tons of carbon dioxide emissions each year. That's like taking almost 20,000 cars off the road. The company has plans to add another 300 megawatts of wind generation by 2027, showing how our participation is part of a much broader impact. This is an example from the Caribbean that has built out our track record in infrastructure, and we recently closed our first deal in the Indo-Pacific financing Gulf renewable energy in Thailand.
All right, fantastic. So you're making headway across a number of industries, I suppose, in different countries as well. I want to touch on some of the key challenges that development finance institutions like yourself face when funding projects, especially in developing markets like the one you've mentioned in the Dominican Republic.
So one of the biggest challenges, public sector resources are becoming ever more strapped. This means that there are fewer public monies to address the huge development challenges, such as insufficient infrastructure and energy security, for example. There just aren't enough public dollars available to invest. Let's use infrastructure as an example. Across developing Asia, there is an infrastructure investment need of approximately $1.7 trillion per year, according to the Asian Development Bank. However, the amounts actually flowing to address this need are significantly lower, less than $50 billion according to the World Bank. So this offers an abundance of opportunities for development finance to invest. As well, really important to mobilize private investment to fill that investment gap. Emerging markets and developing economies do present different challenges. One challenge is developing pipelines of bankable infrastructure projects. Other challenges can include political, legal and regulatory frameworks, and currency risks when investing in hard currencies. But again, this is where development finance institutions like FinDev Canada come in with our higher risk appetite and experience in emerging markets to help address and share these risks with private investors and help close the investment gaps.
Yeah, just on that point, how do you navigate, for example, around political interference in the selection of projects?
So as we're looking at different transactions, we will take a look at how projects have been awarded, what the frameworks are in place on behalf of a government to actually award, whether it's a public-private partnership or a straight-out concession. But we'll definitely look into that to make sure that we understand clearly how those decisions were made.
All right, let's come back around to why you're here. A robust pipeline of sustainable infrastructure projects in the Indo-Pacific that you've got lined up. So just elaborate a little bit more on these opportunities and what these specific aspects these projects are likely to cover.
So as I mentioned just a moment ago, we've had initial success supporting renewable energy in Thailand, and we see opportunities to do more across the region in the energy sector, as well as in transportation, water and sanitation, and digital infrastructure as well. We are also open to smaller and mid-sized projects, what I like to refer to as the missing middle in infrastructure finance, where overall project sizes would reach approximately 200 to 400 million US dollars, and our ticket size would be in the range of 20 to 75 million US dollars. And we're also interested in continuing to design platforms that leverage private investment at scale into energy and infrastructure.
All right, if we dive into the dollars and cents here, could you give us an indication of how you decide how much funding to pump in for each of these projects and how much to set aside when it comes to scaling of the project? Maybe you could perhaps give two different examples to draw a parallel.
A great question. So we work with and through the private sector, and accordingly, our clients have assessed their capital requirements or investment needs. And so our job is to consider those needs relative to our own risk appetite and the realities of our own portfolio. We need to ensure that we're not under or over leveraging an investment so that it remains financially and economically viable. That's sound risk management. In terms of scaling, we don't necessarily set aside capital for this. Fortunately, we're not a capital constrained institution. Rather, our clients will approach us with their plans for scaling and the related financing investment needs. We then assess those plans and needs and consider what an appropriate financial commitment could look like from FinDev Canada. And an example of that might be a client that comes to us and said, look, phase one of an investment is 50 megawatts of renewable. We then want to have a phase two of another 50 megawatts, and phase three maybe is another 50 megawatts. So we'll take a look at that sort of financing horizon or that investment horizon of a client and work with them over the long term. Building partnerships is key to provide financing across that investment journey.
Right. There are some sustainable infrastructure projects that have significant upfront costs, and that can potentially deter investors from going ahead with backing that project. So what kind of financial mechanisms do you think are essential for making such projects more attractive to private sector investors, perhaps those that are on the fence, while ensuring that they meet development goals at the same time?
You're right. Many sustainable infrastructure projects do come with high upfront costs, and there are several financial mechanisms that can make these projects more attractive to private investors while ensuring that they meet development goals. So one example I alluded to earlier is public-private partnerships. These involve collaboration between government and private sector entities. Governments can provide initial funding or guarantees, reducing the risk for private investors. There are also other explicit credit enhancement mechanisms, tools like guarantees, insurance, or other risk mitigation instruments that can make projects more appealing by reducing real and perceived risks for private investors. There's also this growing suite of financial instruments in thematic bonds like sustainability-linked or green bonds. These are debt instruments specifically earmarked to raise money for projects and investments that have sustainability features. And we also hear a lot about blended finance as a development finance institution with an expanded risk appetite. We principally use our core capital or our own balance sheet to execute on our lending decisions. However, blended finance can be leveraged when conditions are right. So what is blended finance? It's the use of catalytic or concessional capital from public or philanthropic sources to increase private investment in sustainable development. This means combining public concessional finance, such as low interest rate loans, with private capital. It helps de-risk investments and attract private sector participation by improving the risk return profile. But it's important to be judicial in the use of blended finance so as not to distort markets. And at FinDev Canada, we have a new envelope of concessional capital, which we can use to make deals more attractive to the private sector.
Yeah, just on that point, the challenges that perhaps constrain the adoption of blended finance, does the size of the project matter, and perhaps the transaction costs as well?
Definitely. And as you mentioned, many infrastructure projects do have high transaction costs. Layering in a blended finance structure takes more time and effort and expertise from a resource perspective. So typically there needs to be a critical mass in terms of investment size to make blended finance really work and actually have the demonstration effect that it's intended to have. Having said that, blended finance has been used across a number of different sectors, from smallholder farmers to micro and small and medium-sized enterprises, all the way up to large-scale infrastructure.
All right, Laurie, it's been a pleasure having you on the show. Thanks for giving up your time for us.
It's a pleasure. Thank you so much.
You're very welcome. Have a great weekend. That was Laurie Kerr, CEO of FinDev Canada, which is Canada's development finance institution that supports the private sector in developing markets to promote sustainable development. Stay with Money FM 89.3.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.